Hi guys, don't look at my hairstyle. I just woke up and I want to share with you guys the crypto investment plan that I've been working on a bit. And it's been a while that I shared it. You can always access the sheet here, and many do. At the current moment, there are 4 people on the sheet. So great to see you guys are also interested in my investment plan, and you can continue to work on it yourself by simply copying the sheet. Make a copy in Google Sheets, and you have it for your own. And then you can see also all hidden rows, and or simply change the values if you want to change the plan. But I do think that that's all a lot of work, and actually you gain the most by simply taking a look. Often I update these plans, and there are often small mistakes, and you will see, and but over time these get worked out. But super important to have an investment plan, because it's investing so often goes against your initial basic instincts. When the price goes up, you are afraid to miss out, and the higher it goes, the more that feeling of FOMO, the stronger it becomes, and the closer you get to the buy trigger, right at the wrong time. And that's my biggest problem, not the fear problem that many newbies have, where it goes down a lot, I can't take the pain anymore, let's sell. That was my problem, but many decades ago. But today I still have the problem of FOMO, because the investments I have are very good investments that I believe will go up a lot in the long term. So the fear of missing out, of missing the train, really is the hardest for me. And an investment plan really helps me a lot by looking at the longer term perspective, and trying to estimate probabilities correctly, and see like how and if you see that it is actually quite likely prices will go down again, it's much more easy to not give in to the FOMO, and to be able to be disciplined, and have patience, which is very difficult, especially for me now. I shared yesterday my portfolio here on Twitter, also updated the sheet, and I sold all my calls, and as a consequence, I'm at 40% cash, and that's of course a lot. I think cash is the worst investment. Like, it's not, you can't even call it an investment, because you're sure to lose 5% per year. It's like buying a brand new Ferrari. You're not gonna make money with that. It's for sure will go down every year with 5 to 10% in value, even if you don't drive it. It's the same with cash. So it's not even an investment. But of course, you have to go through cash before you can invest in other things. But like, I am very uncomfortable with cash. I believe it's not even an investment, and it's much better to have a bunch of investments. Like, you can always sell an investment for another investment, and so I really need to invest this money. And So my plan is to go to 53% crypto if we reach these price levels for Bitcoin Cash, Ethereum. But this comes from the other plan, the crypto investment plan, where I set targets. And so the next real target is double testing the bottom. We reached that bottom shortly. I testing the bottom. We reached it on the 13th of March, 2 months back. The same day when we reached 150 billion, we also reached 115 billion, but it was a flash crash. And for example, yes, Bitcoin Core went from, when it was 150 billion total CMC, total market cap. Bitcoin Core was still $5,000, and it went to below 4,000 when we reached like 115 billion. But many other coins Ethereum did also go lower to 90, but for example, Bitcoin Cash, yeah, went not that much lower, but it did go to a low of $145 dollars on some exchanges, but not on Bitstamp. Kraken actually it went to maybe 155 or so, or yeah. So. But anyway, I think that testing the bottom, although we did it shortly here, and I've predicted very very long that it was likely that what that would happen. Let's take the other sheet moments. Yeah, I just published this video here, and many people thought the bear was done here, and we went into a bull market, and but I thought this low was likely to be retested, even when we went up a lot here, simply because of past patterns. In previous cycles, the bottom always got retested, but of course, that had a different meaning in the early cycle, where prices go up quite quickly. So testing the bottom is a lot higher than the actual fiat bottom. But in the second cycle here, testing the bottom actually was already a lot closer to the fiat bottom and happened only a year later. So that's why I thought it was likely that, well, first of all, we make a new high in undervaluation. So once we went up here, I thought, yes, we will likely go lower versus the red line, versus the trend line in the future sometime during this early bull cycle, which then happened here. And then it went back up, but then you had the corona crisis and it all collapsed again. But we also reached a new low in undervaluation that I also thought it was likely, since that's the pattern of previous cycles. And But it was so short. The bounce from it has again been very strong, and this is something also I tweeted yesterday. It's so strange how crypto has been acting. Look how a clean bear market you have here, and an early bull market, a clear bear market, and then a sideways movement, and then an early bull market. It's very clean here, the previous cycle. Even before here, yes, it's more choppy, but if you look compared to the logarithmic trend line, which it means that growth goes up, but slows down over time for every new investment or new company, fast growing company, as normal, also for Bitcoin and crypto in general. And even then, you see that, yeah, it's quite clean, though not this cycle. I mean, yeah. I mean, it's when an asset is valued 10 million or 100 million US dollars, it's going to be a choppy ride, because Bitcoin in the early days, 2011, 2012, was all brand new. So it's hard to value something like that. So you have lots of volatility. But now we are 10 years in, and still it's very volatile, which I find very weird. Uh, the bear market was stronger than I expected. It corrected too much in 1 year's time. But then you had a strong rebound, which was also really not expected by me and many, I believe. It's such strange behavior. But then again, we went down so sharply, up again, down. It is extremely volatile for where we are. We are in the early bull market. It should be a boring period. And It's not there yet, but I do believe it's probable to come, and so that we will revert back to this green line here and go into a valuation of not 60% versus the trend line, not 50%, but 40% versus the trend line. That means currently around 150 billion, and that we go up like we did here and like we did here, slowly but steadily, with very little volatility. And most people experience that period actually not as an early bull market; they experience it as a bear market, because even though prices go up slowly in fiat, they are still a lot lower than the all-time highs that were there years before now. And so all the speculators and innovators that want action leave the market, and so actual real building is being done there of use cases, this is the period that where you want to see transactions go up a lot, and utility and usage by the of the cryptocurrency go up a lot faster than actual price. And we're still not there, not for Bitcoin Core, and yeah, things like the NVT ratio show that. But let me also show the amount of text. So this is the active addresses of BTC, Ethereum, and Bitcoin Cash. And as you can see, since the peak of the bubble in 2017 at the end of the year, the amount of active addresses has gone down for these three cryptos. Um, Bitcoin Cash the most, like there used to be a lot higher active addresses at the peak. Ethereum also used to be a lot higher, and Bitcoin BTC also higher. Um, but what you want to see is the amount of active addresses go up again, huh? And of course this is related to price. You can actually see that this is very similar to how high the price was, the amount of active addresses, most at the peak of the previous bubble, and then we had a strong rebound in the middle of 2019, also a lot more active addresses. But now, yeah, what you can see is relative to price, actually, that Ethereum is doing pretty okay. And yeah, Bitcoin Cash, it collapsed a lot in price. The amount of active addresses lost is similar to the amount of price lost. So I do think that um, um, price and is the leader here in setting the activity on chain. The higher the price goes, the more investors that become active and create activity online and use active addresses. So price leads in a big way. But as an value investor, what you want to see is that when the prices become boring, do you see an increase of the amount of active addresses? That means actual real adoption, real utility, which was the case, for example, in 2013 when I started investing in Bitcoin BTC. I noticed that wow, the amount of activity had gone up a lot the past year, but the price, not the price used to be $30 here, and actually it was $10 here when I invested. But the activity was a lot more than at the peak of the bubble before. So that's a great indicator. That's what you want to see. Similar to a company, when the valuation is still the same, but the revenues in the meantime have like 5 or 10 folded. That's a great moment to invest. Same with cryptocurrencies, huh? And we're not there yet. Huh? That's a real problem, and that confirms the analysis that we likely really are not ready for a strong bull market just yet. First, we need to see on-chain usage pick up a lot for all coins, and go faster up than the price. Still not happening. This is transactions, not active addresses, but transactions. And here actually looks much better for Bitcoin Cash. You can see that since the peak of previous bubble at the top of 2017, actually the amount of active transactions has gone up for Bitcoin Cash, despite the price being cut by 20. The amount of transactions on chain has actually gone up a lot, considerably, yeah. So it was 30K here, and today it's like 40K. It has gone up. For example, look at Ethereum. It was 600K, and now it's 750K. It has gone up also. And if you look at BTC, yeah, BTC. Sorry, no, I read that. Yeah, I read that correctly. No, Yeah, it depends where you measure where the top is, of course, because Ethereum, you could say the top is here, and that's 900,000 transactions per day. It hasn't breached that yet. The top for BTC, of course, BTC can't have more transactions. It's physically impossible. But it had 300,000 at the peak, and now it still has 300,000. So there is no growth here. For Bitcoin Core transactions, there is no growth, but that's also the case for Ethereum, and there is actually a little decline, except for Bitcoin Cash. Compared to the peak when the price was the highest, it was 30,000 transactions. Today it's 40, so that's gone up. But of course, transaction cost very little on Bitcoin Cash, much less than Ethereum and Bitcoin Core. So, of course, you're going to see much more growth there. And of course, there's the risk also of manipulation of the number. It's very easy to fake transactions when the transaction cost is very cheap. So, but I do think it's logical that, because I had some good questions yesterday from someone doubting whether Bitcoin Cash is a good investment. Um, it's only normal that people that build something on top of a cryptocurrency really want cheap transactions. That allows a lot more use cases, allows their platform or their service to work much better. So it's only normal that you will see transactions of Bitcoin Cash go up a lot faster than Bitcoin Core. But you also want to see that reflected then in active addresses, which is not the case yet for Bitcoin Cash. And you also do want to see that over time. Um, you see it more with Ethereum, that active addresses is holding up better. Um, But I got some good questions about my investment plan here. Someone asking, yeah, but why are you, for example, planning to invest already when crypto drops only a little bit? Um, and the reason is that actually, indeed, plan to invest my total cash position of 40%. That will go up to about 44% of my portfolio if indeed crypto and Tesla drops. So it will be close to 50% cash. I plan to invest all of that on a small correction. Why? Um, because uh, because what I stated at the beginning, I believe cash is not is a very bad investment. So all these things at these prices are much better investments than cash. And so I'm not the kind of investor that has cash. I don't hold cash. Only flip investments. Only when we are at peak at clearly euphoric valuations in the stock market or in crypto, when everybody is predicting much higher prices, when gains the past year, 2 years have been tremendous in the sector, then yes, I go to cash. Or when something very when there is clearly Armageddon heading our way in the case of coronavirus, yes, then I go to cash. But this is very shortly, because you're very close to very likely a very hard crash. But today we are not in such a climate at all. Yes, now everybody or the masses are all pessimistic and negative, but past performance of the crypto market past few years has been very bad. People lost lots of money. This is not a time to be in fiat. It's a time to be in crypto. Same for stocks. Stocks have gone sideways the past 2 years, and we are in a bull market. A long-term bull market. I made other videos on that. Check that out. That's very important. The kind of even with the rebound that we just saw, we are still when we look at valuations, for example, S&P 500 here, since the 1930s, people now talk about Warren Buffett about, well, yeah, but be careful, we can be in the Great Depression, and this is only the start. So that's what people think about and are afraid from, and that's why many people predict lower lows, that we will breach the bottom and go a lot lower. And Warren Buffett, on his recent call speech, said that it took from 19 it took 30, 40 years to breach the all-time high of 1929 here. Indeed, 1929. It took till 1955 or so to breach that. So that's 25 years. And that's what he thinks can be the case today too, that it can take 25 years to reach this all-time high. But I think this is very misguided. Why? Because look at the bigger trend. You can see sideways, up, sideways, up, sideways, up, up. This is logarithmic. It tenfolds every time, and so you can really compare periods. How much does because this is you can call a long-term bear market of stocks, bull market of stocks, bear market of stocks, bull market of stocks, bear market of stocks. What do you see clearly here? That is that a bull market of stocks goes, well, it takes, if you go from the sideways movement to up, how long does that take? It's 20 years. 20 years up, 10 years sideways. Because yes, it took till 1955 to breach the all-time high. But as a stock investor, you invest, actually the low was set already in 1932. The bull market started here of stocks, not here. Here, 20 years before that. That was the low. That's the start of the bull market. People call the whole 30s the Great Depression. But an investor that invested at the bottom here did not experience a Great Depression. He was making tons of money. And that low was never hit again, not even close, 10 years later. But you could say, like, okay, if you look at other economic indicators, this is the Great Depression period, then you could say the bull market starts here. That's like from 1940, 50s, 60s, 30 years bull market. 1970s was bear market, 10 years bear market. 80s and 90s, 20 years bull market. We've seen then also 10 years bear market from 2000 to 2000. You could say the bottom was in 2009, but you could say, okay, let's say till 2010, it was really like bad climate. Okay. But that means we're in a bull market now. How long? Not even 10 years. Did you ever see a bull market that lasted only 10 years here, the past almost 100 years? No. Bull markets last at least 20 years and possibly 30 years. And when do they last 30 years? When you saw a Great Depression. Did we see a Great Depression here? Yes, we did in 2008. International trade went down, what, 80%. The economic shock was very high. Many people and companies went broke. It was a true cleansing of the system. So they didn't call it depression, they called it the Great Recession because, well, it was a little bit less worse than here. But the bull market before was also a little bit less good because that you can't see. The bull market in the 10s and 20s, 1920s was crazy. S&P was somewhere here before. So and the correction was also bigger. Money printing also, we can take a look at that too. But yeah, so this is a long-term bull market. It is very clear. Also, this chart, returns, average returns, the past 10 years for stocks blue is very high in the 50s, goes down in the 60s, at the 70s, it's very low average return for 10 years. Then it goes back up. Bull market for stocks again, 80s, 90s. Bear market, average returns negative after inflation, again in the 2000s until 2010. So the trend is clear, bull, bear. So we're now in the early bull market. We are in 2020, it's right here, and that's similar to where we were. Let's go back. 1984. That's where we are in stocks. The start of the bull market. Oh, let's go here. Okay, here these returns here. Average returns for stocks here 2019, and it's lower now because we saw a correction. But the average return 2019 is 9% the last 10 years. But you have to deduct real inflation of 6%. So after real inflation, it's only 3% per year average returns. And that means it's 3% here. That's where we are. And if you see 3% here, that's the same as average returns of 3% here, was early 80s. Average returns of 3% here in an uptrend, was early in the 1950s. So 50s and 60s were golden years for the stocks, and very likely we'll see golden years again. Also, inflation argument is important. You don't see it because I don't have 2020 yet on this sheet, but indeed we saw a very high inflation in 2020. The amount of money printed is similar to, actually a little bit higher than 2008, where they also doubled the amount of money in circulation. They did the same now. Does this cause inflation? Because many people now predict hyperinflation. No, and it's very clear from the chart that average inflation, despite sometimes having very high inflation, amount of money printed is sometimes very high, the central bank usually in the West, in the US, Europe, are smart to after that actually do the inverse. And instead of creating more money per year, they actually destroy money every year. And that causes, let's say, the average last 10 years, for example, after 2008, by 2011, the last 10 years they had printed 15% per year on average over the last 10 years. But then the years later, sometimes they destroy money, sometimes they increase again. But overall, the last 10 years, as of actually 2019, the last data we have, they only printed 6% per year the last 10 years. But what you see is that if you take the average since we started measuring here in 1916, I have the amount of money they printed. The average is 5.6% per year that they, sorry, not printed, is 2% more actually. It's 7.6%, so almost 8% that they print, but you do have to deduct 2% for economic growth, because we want to know how much is the purchasing power of the money losing. That is not directly, like it's not how much they print, it's how much they print minus economic growth, because let's say they print 10% more, that means the value goes down by 10%, except if there are more products and services in the economy, then actually the value goes up. Let's say the value of the amount of money in circulation stays the same and they print nothing. Well, next year there will be 2% more goods and services in the economy for the same amount of money in circulation. That means you can buy 2% more with that money the year later. That means the value of the money has gone up with 2%. That's what happens every year. If you would not print more money, the value would go up with 2% per year, if your economy grows with 2% per year. So if they print 8% per year, then you can deduct 2%, because that will cause about an inflation of, you print 8%, it will cause about an inflation of 6% if your economy grows with 2%. So that's the case here. So we won't see hyperinflation because it's extremely likely, like they did every other time. Every other time. Here you see even the Great Depression numbers. The Great Depression numbers. Let's remove this one. They printed tons. That's why you had an enormous bubble in the 20s. Sorry, that's not the Great Depression. This is before the Great Depression. In the during World War One, they printed a lot more than they've been printing today or in 2008. It's not doubling the amount of circulation. It's like quadrupling. It's like five-folding, six-folding the amount of money in circulation, like they still do in Africa and South America. That's what they did 100 years ago also in the United States. And that of course causes massive booms and busts, because valuations go up a lot in the 20s. They call it the roaring 20s, but actually inflation also was very high. And it caused also massive crashes in the stock market later on then. But anyways, that's why I'm optimistic. Like, people don't see the long-term history here, but actually monetary management of the fiat currency is actually improving over time. Politicians over time become wiser, and central bankers, and don't print so much as they did in the past, which lowers inflation over time. For example, the last 30 years here, by 1945, we can measure 30 years of inflation here. It was 16%. If you look today, the last 30 years, it's 7%. Since we started measuring. So over the long run, they actually print less and less as a percentage, and so inflation does go down, but it's slow, and it's still very high today. It's still 6%, which is yeah, very high. That's why cash is still a very shitty investment, because you also get 0% interest rate today. So, um, saying all that, this is also interesting that you can see a correlation between the amount of money printed and the climate, the economic climate. It's typically that during recessions and depressions, bad times, they print more than during good times. And so they just printed a lot. Well, very likely, and this is a rare event, when do they print a lot? On average. Well, we have a period here, and that's of course due to the crisis here, very bad returns, but it's very rare that they print a lot actually. We have to go back to the World War II. That's 50 years before that they printed a lot. And then it takes until World War One, actually, that they also printed a lot. So, and all these periods are not good periods for stocks, but after you do get very good periods of stock a long time, and they reduce the amount of money in circulation, here too. So that's likely to happen again. It just started, but it's likely to continue. This coronavirus crisis is not a financial crisis. It's a medical crisis, and therefore I've predicted from the start it will likely be short-lived, because the economy is healthy as long as you don't threaten people to go to work, with violence and with jail time. If you let people do their thing, the economy is healthy, and people produce a lot and consume a lot. Um, so what we saw in the S&P 500 is in stocks is a sideways movement that's likely to go back up a lot, and so objectively speaking, yes, we just did a strong bounce, but it could certainly continue to go up if there is a strong correction. That's a buying opportunity. That's the right time to deploy your cash. And for me, for example, Tesla, I saw a bottom of 350. It went up to 890. So if I succeed in, if it gives back half the gains, that would be great. And I do think that is still at least a 50-50% chance. If you look at corrections during a bull market, strong corrections during a long-term bull market are rare. Actually, when did we see that? We have to go back to previous bull market of the 80s and 90s to see strong corrections. It's rare, and everybody know when it happens. It was 1987 here. So here it was a strong correction. After a strong rise, a strong correction, people talk about a recession, but how long does it take to recover again to a new all-time high? Well, 87, 88, 89, so 2 years to breach the all-time high again. This gives me confidence that the bounce we are seeing right now is going too quick, and we will likely see see it be choppy. Despite the economy being good, despite we seeing it go up, people start to get out again, start producing again. Typically, strong corrections don't V-bounce out of it. It does take time. What other strong corrections do we have? Um, I would not look at the 70s. This was a bear market for stocks. Let's look at the bull market for stocks here. That was indeed from the 40s. Here from the 40s, 50s and 60s. This is another strong bull market. How long does it take when you have a strong correction after indeed 5 to 10 years rise? Well, it does take, here it takes 5 years. Let's look at another one. You have a peak here. How long does it take after a strong collapse to breach the all-time high again? Well, the top was here, 57, in the middle of 57, in the a little bit over 58, so over 1 year, we breach the all-time high again after a strong correction. So it does take 1 year to breach the all-time high again. Same here. We drop in 1962, still a bull market. How long does it take to breach the all-time high? Up 1 year plus 1 year and a half. And so that's typically the duration to breach the all-time high is 1 year, a little bit more than 1 year. So to think that we're going to breach the all-time high here at this rate, that would mean in 3 months. That's not likely because it did not happen in the past. It will likely take a year, and so that means by the middle of 2021, probably by the end of 2021, because the peak is in 2020. So at least in 2021, probably middle of 2021, we only then will breach on all-time high, and so that means that we can't continue to go up at this rate. We would breach it already in 2 months, 3 months. It's likely going to take another year from here. And so that means that it likely will be choppy. It will likely go up like this, as it did in all previous recessions. So that's why I believe it's worth taking the risk to not invest today my money immediately in my favorite investments, but wait for a correction, and but not hope for too much. You can't hope for testing the bottom. That's not going to happen. We're not going to back here. That's very unlikely, because we're in a long-term bull market, not a long-term bear market. And so if you look at these previous recessions that we just looked at, the bottom is reached in the beginning, and after that it builds back up, but it never reaches its bottom again. So counting on giving back half the gains is possible. It's possible. That's the kind of corrections that happen. Let's go back here. 1987. It goes up from the bottom to the top here. Then you have a correction here. How long? From 270 it goes to 250, but it came from 220 220 till 270 is 50 plus. So you deduct 25, half of it. You set your buy the orders at 245. Will they get filled later? Let's see. No. So maybe I should set a little bit higher to see it filled. Maybe I should set, for example, Tesla at 700 and not 630 to have a higher chance to see it filled. Someone asked also Ryanair. Something interesting. So why am I interested in investing in Ryanair? Well, Ryanair is one of those few companies that's led by a great leader. His name O'Reilly, Patrick O'Reilly or something. An Ireman, an Irish, but a very frank person and very controversial, and has really innovated just the industry of flying in Europe by with his budget airline. And became a billionaire from little, and has really revolutionized the flying, lowered the price per ticket a lot, and forced many competitors to do the same if they want to stay in business. Maximum data revenues. have gone up a lot. Well, it's 200. It's today revenues are like before the crash. 2019 is about 10 billion revenues, and let's go to 10 years before that, 2009. Revenues 4 billion, so doubled his revenues in 10 years. That's not spectacular growth. That's nothing compared to Tesla. um, but we're not in but airlines have been one of the industries that have been hit the hardest in this crisis. And when I'm asking myself, okay, what opportunities are there today, it's in the industries that are hit the hardest. That's where the opportunities are. But you want to take something that has proven to do very well in the past, because many go broke for a good reason, because they were weak companies. But some actually won't go broke, have no chance to go broke, but do get a big correction. And I think that's the case with Ryanair here. If you look, for example, at the market value, it's 12 billion. It comes from 30 billion, so cut by three. Um, if we look at the value of the company compared to the book value, well, we went a little bit lower here in 2009 financial crisis, but we're at similar. It never went below book value, the company. We can't expect that here also. But this crisis is a bigger crisis for airlines than the 2009 financial crisis, where no planes were grounded. Maybe they, at the worst months, they had 50% less traffic, but today it's like 100% less traffic for 3 months, 4 months. That's like a much worse crisis for the airlines. So I do think that we will go at least the same or even closer to book value for airlines. And so that's why I'm trying to buy below the low. If you look at the price of shares, the price of shares, the highest was 110 euros or dollars. Dollars, I think. Yeah, it's quote on Nasdaq dollars. Also, yeah, it's now it went to a low of $50 here, and now it's back at $55. I'm setting my prices at $40, 43, because I think that it has been a very weak bounce. In contrast, S&P 500 has bounced strong. Tesla has bounced strong. Amazon, Apple has bounced very strong. The big tech, but the airlines and the cruise lines, and no, they have not bounced strong at all. So when the market corrects a bit again, just the general indexes, um, I think that will create a new low for these industries that have been hit the hardest, and so for Ryanair too. So I think that since the bounce was so weak, if we have another little fear coming back to the markets, it's very easy to make for them to make new lows. So that's why I set my prices there, but I don't set them too low. Um, like for example with Ryanair, you can't expect it to go below book value. Yes, it's possible, but is it probable? I wouldn't say it's probable. If you set it at book value, that's around 9 billion or 10 billion. Well, that's where I'm setting it, my prices, but not below book value, because well, the climate has been improving a lot. Ryanair and many airlines are starting to fly again this month, in next week, in 2 weeks. So the good news is about to come. So the time to invest in these kind of companies, like the peak fear and the worst news has all come out. It cannot get worse than that. Any news that comes out these days will be positive news. Except for looking back at the when the numbers are released for quarter 2, terrible numbers, but everybody knows that the numbers will be terrible. There was no business, so that's priced in. But all the news that comes out now, like people think will be locked down for many more months, is very unlikely. People think we'll have severe regulations in airlines, and people, the middle seat rows will not be able to be sold, and we all sit with masks on the airlines, and let's see about that. Fear came quickly, but it also can go away quickly. So um, the time is very limited to invest in this. You can't set it too deep, because it's a once in a lifetime opportunity to invest in companies like this during a crisis like this. So that's my reasoning behind this. For crypto, I set double testing the bottom as a high probability, but I do set a step in between. Um, the step in between is between this step, double testing the bottom, and the bounce that we just saw. We went to 260 billion. Um, uh, I think we still have a good chance to double test the bottom, but not 66% as before, because we already tested the bottom. That's when I gave it 66% before we tested it. But once we've tested it already now, double testing it has a lower probability. So I lowered it to 55%. Also, the amount of volume in crypto on the exchanges was very high when we tested the bottom for the first time. So it's unlikely, actually, that's likely a reversal. And so it's unlikely that we go back there, is one logic. Of course, you do have the Trollo chart here that suggests that it's likely we go back to 150 billion, yes, but not 110 billion. That's also not what the Trollo chart is saying. It's like to go back to 150, but not, and that's if we correct now. But will we correct now? It could take many more months before we correct. And in that time, the trend line is higher. And by that time, if we go to 40%, it's actually not 150 billion, will be 170 or 180 billion. So that's what the trend line says, that likely go back there depending on when it happens. But a fiat valuation of 110 billion is actually not likely. And therefore, I think my probabilities here are actually maybe still too high. And maybe I should lower it a bit. Let's lower it. It's not 55. It's a toss-up. Yes, it can happen, but it's certainly not likely. But this breaking the bottom is unlikely, has become more unlikely. I used to say 33%. No, it's only 25% here. Maybe I should lower that too. Because when I lower one, I should lower the other one too. And this is very important to have these probabilities as correct as possible, because asset allocation depends on that. How probable it is to correct defines the Kelly allocation a lot. For example, this just flipped from 53 to 54% that you should be invested if we reach this target due to lowering this probability. But this is also very interesting, the way I count asset allocation. It's very important. I do this very well for crypto, but not for the other assets. I don't do that for Tesla or for Ryanair or for stocks in general. No, because my main focus is crypto. My goal during this bear and now early bull market is to invest as much as possible in crypto, and then just sit it out, like then not sell anything, keep it for a 2-3 years when we like to see a next bubble peak. In the meantime, not sell anything and really work on making crypto happen. So the challenge is just for me to, when I invest in other stuff like Tesla or Ryanair, the goal is to just invest my money wisely, so I have as much money as possible to invest in crypto. So my main focus is how much should I invest in crypto, knowing that crypto is such a wild horse, and it's so hard to do that right. And that's why I use um, many criteria to judge whether we're overvalued or undervalued, but also to judge how much you should allocate. Huh? And for example, um, um, why is my target 54% if we reach again 180 billion today? Um, and not more, because most crypto investors would invest a lot more if we correct again to 6,000 for Bitcoin Core, or 160 for Ethereum, or 190 for Bitcoin Cash. Many would say go all in. I don't, um, because I know that the Trello chart suggests that we actually go to about, well, for a new high in undervaluation, 40%, and we'll be there for a long time. And that means that, yeah, today that's 150 billion. In 1 year, that's maybe 200 billion. But those are the average prices, and so you can easily shop below it, especially since the market is still overly bullish and doesn't expect that to happen, and so will be disappointed. And there is a lot of money in crypto that's just there to make money, does not invest in crypto for the fundamentals, does not care about adoption as a currency, is not working on it being adopted as a currency. So fundamentals are weak, and so that means that they will they are much more likely to sell if they get disappointed and bail out. And That's why I remain careful and rational. It's very clearly the Kelly criterion is a scientifically proven way to allocate your capital. It is the optimal allocation for the risk reward that you get. And for example, if we reach 180 billion, what's the probability that we go lower? Well, it's 50%. It's a toss up. Okay. What's the downwards potential then? Well, we would correct if we double test the bottom from 180 billion back to 110 billion, back to in the 3,000 range. What's that? What does that mean? That's another 40% loss. Sorry, this was upwards potential. Well, the downwards potential is 50% we go down and we reach this, but there's also 50% chance that we don't reach this next step anymore, and we go. And over the years, we will go into a strong bull market and reach all-time highs. So the upwards potential when we are here is, I should change this, is, let me mark this because this is wrong, so that I don't forget. But the upwards potential is 14x for the whole crypto market. From here, from the 180 billion, it's possible, probable actually, that we will reach 2.5 trillion in about 3 years, 2 years, 3 years. So that's a 14x upwards potential. Okay, 50% chance to reach that, but also a 50% chance to go down by 40%. That means the expected outcome, your edge, is you're going to sixfold your money. With such probabilities, the expected outcome is to sixfold your money, not to 14-fold it. The expected outcome, the formula, if you do the calculation, you just do this time this plus this time this, you get expected outcome of 6. And the Kelly formula, you divide your upwards potential, the 14x, by the expected outcome, something like that. I have it on Twitter here, well explained. Take a look at it. It's really good. But yeah, for that you do at Mark de Metel, Kelly posts. This is indeed the reply to the good post that I made. Nope. Magical Kelly. This is a very good one because it explains it very well. Expected return is you have 60% chance to make 50%, plus you have 40% chance to lose 25%, plus 40% to lose 25%. That will give you your edge, your expected return. And you also, and the Kelly criterion is simply dividing your edge over your odds, and that will give you the amount of money you need to allocate to it to have an optimal return. And so when you do this with crypto, you get if you do just one, just the Kelly formula, then you get, okay, we need to allocate, if we reach 180 billion, 48%, according to the Kelly criterion. But you don't want to do full Kelly, that's risky, because I don't have that here. Oh, I have it here, the explanation. No, this is not a good one. The good explanation I seem to have here. No, here. Huh? I thought I had it here then. Huh? I know I have it here. Recommended Kelly allocation. Yeah. So usually you want to take half Kelly because you will have 75% of the optimal returns with half the volatility. This is also what the inventor and also what Edward Thorpe, the one that really implemented first in the world of investing, recommends to do half Kelly. But then it depends. Here at Thorpe, I have him quoted. We are not able to calculate exact probabilities in the world of investing. So all these are just guesses. I'm guessing there's a 50% probability that we will double test the bottom, but that could be wrong. It's my personal educated guess. But if it's wrong, the big risk is here if you invest too much. Big problem with Kelly is that if you overinvest, if you overallocate, you will have less than optimal returns, but you have much higher volatility. So that's really a very bad deal. So you certainly don't want to overallocate. That's really unwise. So if you want going to make an error on the downside because you allocate less than the optimal allocation, yes, you will make less return than optimal, but your volatility will go down a lot too, which is actually very good as an investor because volatility fucks up your mind. If your portfolio goes up a lot, the greed kicks in much more easily. If your portfolio goes down a lot, the fear kicks in much more easily, and that's when you make the big mistakes that I also do myself. So actually, you want to avoid volatility, but you want to have great returns. But you want to not have a high volatility in order to reach it. So err on the downside, that means you do half Kelly, or what Ed Thorpe says here. In addition, there are things that are going on that are not part of one's knowledge at the time that affect these probabilities. That's also true. And somebody that also gave a great mark. Mark, did you take into account that because of this crisis, actually innovation accelerates, and that also applies to crypto? And so we may see, just like with electrical vehicles with Tesla, a much bigger shift and from work from home, for example, today, and teleconferencing and video chatting and all these kind of innovations suddenly, and just the internet in general, because of the crisis, suddenly goes up a lot faster, or music streaming, or uh, yeah, all these services, or gaming, like all these services suddenly see a big boost in going see adoption much quicker than they expected. And at the same time, old industries and legacy automakers, for example, see their industry collapse much faster than they expected. Clearly you can see it in Tesla, where car sales are actually not that bad for the crisis, and the gap between, whereas with legacy car makes it a total disaster, the car sales are gone. And so it's and that yeah, you have to take into account also, when judging like how strong will the correction be. There's so much good news coming out for Tesla now, that actually it may not correct as low as I expect. And but the same is true for crypto, huh? The Trollo trend line is based on past growth, and many people give the argument today that due to this corona crisis, crypto will likely grow slower, but it's the inverse, huh? Due to this coronavirus, likely crypto, since it's part of the innovative sector, will likely start to grow faster, huh, again. So, did you take that into account? Actually, no, I have not taken that into account when I estimate my probability. So let's just do it right away, huh? Let's lower this again. But I also add the arguments. Well, I have added it. Um, from 66 to, and I will lower it again. First I lowered it from 55 to 50, but now I'll lower it to but let me also write it. It's done. It's done. I lowered it from 50 to 40%, and I also write why, huh? But I think that yes, we mentioned this. Okay, so we went from, I lowered it from 50 to 40%, as we saw a serious crisis, and generally innovation accelerates in growth, huh? Which lowers again the chance that we will hit this low. So that means that due to that, we go from 53% to 63% recommended allocation at this step already. If we would reach this step, recommended allocation is 73, and this step recommended allocation is 83, but very unlikely to hit. This is still probable, but not, possible, but not probable. And this is improbable. Possible, but not probable. This actually should be lowered to, oh no, that's an average, so that's automatically changed. But yeah, 60% chance, I believe we still hit these price targets, which is in the middle between the next price target where I want to buy and the bounce that we just saw from 260 billion, 110 billion, the middle is 180 billion. And I was explaining the Kelly criterion, which is very important, but we don't use one, we use 0.67. So that changes a lot. Its recommended allocation at this step is now 57%, but I think it's an improvement. Um, so here expected outcome, the edge is now not 6 but 7. Um, Given these probabilities and upwards potential for my favorite coin, Bitcoin Cash, at these prices, $190 is 60 multiplier. For Ethereum at $160, it's 20 multiplier. And if we reach 6,000 for Bitcoin Core, the multiplier is still 7. The potential multiplier at the when we reach the peak for Bitcoin Core will only be 40K, but that still means times 7 from there. I only go to full Cali if we reach extreme scenarios. Only if we would reach a scenario like this, which is very unlikely, but if it would happen, then you go full Cali. Because then the market is totally destroyed and nobody dares to invest this, even me. Yes, my sheet will say 90, but expect me to add some steps here that are to go lower and increase the probabilities that we will go lower, which will then lower the recommended allocation. From 80 down. So that's typically what the mind does. And so that's why an investment plan is very important to keep it rational. Keep your preferred allocation rational. You don't go full Cali, but in extreme scenarios you can, but not before. And I build it up. I started at half Cali at the first steps here. The first big step was actually new high in undervaluation, if you remember. Actually, that was already 60% Kelly. Okay, 67. Testing bottom is 75. Yeah, that's still the case. Testing bottom is 75% Kelly, but likely won't reach that anymore. Double testing bottom then. But right now, I have a 0.66% Kelly, which is reasonable, and that actually says that you should only invest 40%, not 57, as I'm planning to do. But I also use other indicators to decide how much I want to allocate. And of course, the first one actually that I started using was not the Kelly allocation, but the Trollo allocation. Just judging where we are, how much are we undervalued compared to the trend line, and yeah, based on historical numbers, deciding like if we would reach minus 70%, which I believe is the max, or the maximum possible allocation, though. Um, Sorry, under the maximum amount of undervaluation that we can do to the trend line is well, if we would break the bottom and we go to 66, and by that time the trend line is up from, this is actually wrong. Okay, goes up to 410 billion. That means that we would have an undervaluation of 80%, which would be absolute new records, never seen before. That means we would go to 20% here, 60, 40, 20% here. Mm. It's very unlikely to happen, but if it would happen, then I would want to be have my maximum exposure that I prefer. And for me in crypto, I prefer to allocate maximally 80%. So I set that as a maximum. Huh? And also I set a minimum, you could say, which is when I really wanted to go for the first time to a majority allocation, 51% majority allocation. I want to do that when we reach serious undervaluation according to the trend line, which meant that we would go above 35%, which we reached. And then I want to go to majority allocation. Um, uh, but I want to reach my maximum allocation when we reach this breaking the bottom, and I also don't want to invest anything more after that. Don't want to go to 90% or so. So that's one way where I decide how much to allocate, and all the rest is deduct from those numbers. Actually, I changed this, and I changed my maximum allocation to the step before. I said, actually, no, I want to try to have the maximum allocation where I think the fiat low will be reached. That's the goal. From today, and that means can't I go back in the past? I think we already saw the fiat low actually a long time ago, over a year ago now, right here. We went to 100 billion, 3,150 for Bitcoin, 80 for Ethereum, and 75 for Bitcoin Cash. We didn't breach that, and that's now over almost a year and a half ago. I think that was the low. But I forgot my train of thought here. What was I saying? Yeah, so is there another fiat low? Actually, I think we just saw another fiat low that we will never see again. And that was the testing of the bottom that just happened, huh? A month, 2 months ago. I don't believe we will see these lows again. So I think we missed another fiat low to buy. If you didn't buy there, what's the next fiat low that we can expect? Because that's where I want to go to 80% allocation. And actually, maybe I should change this again, because we went below 50%. The moment we go below 50% means it's not likely we will hit it. And so I also don't want to count on that to happen. And I also don't want to only go there to my maximum allocation. I want to do it earlier. So actually, if I continue this thought pattern, I would bring this 80% to here. And because I believe actually I should bring it to 150 billion, the step where I think is still probable to reach, but 110 billion not. So I should add a step in between here, and set the 80% there, and that will then increase also my recommended allocation when we reach 180 billion. I'll do that. I will make another video on that, update the sheet, and later another video because too much work. This video takes too long. Also, was just looking a little bit back here at Ryanair. I really like Y charts, but it's very expensive, $200 per month or so. But it is a very good way to judge a company. The first thing I look at is the revenue growth, and I was saying it doubled revenues, but actually that's not good. In 10 years for Ryanair, doubling revenues is weak performance. Huh? Tesla, for example, tenfolded its revenues in 5 years. Huh? So I mean, this is really bad growth, and now I want to compare that with my other potential investment, Illumina. And let's take a look at the revenues of Illumina. Let's remove market cap. And let's just remove Ryanair. Illumina in 10 years revenue was 600 million, and now it's 4 billion. See, this is what I need. That's what I need. Not from 600 to 1.2. That's weak growth. This is from 600 million to 4 billion. That's strong growth. It's like eightfolding, not doubling, eightfolding. So I think I'm gonna have to revise that plan to invest in Ryanair and flip it for Illumina. Yeah. Because growth is really is everything. You really need to see fast growth in revenues. Yeah, that's very important. Of course, also look at a relative valuation, market cap today versus the revenue. That's a problem with Illumina. You see, like the revenue grows a lot slower than the market cap. That's a real problem. And the price per share. This is, I'm looking at Illumina, the same story. So that's a problem. Yeah, the value of Illumina is 50 billion, is very high. Yeah. Sorry, revenues grow slower than market cap. Revenues here you see in 10 years. Yeah, it's crazy. In 10 years, 100 million revenue now to 24 billion, but even in 5 years, 3 billion, 24 billion. So this is not just, yeah, this is actually, yeah, almost tenfolding. Actually, revenues go up the same rate for than Illumina. Let's compare the two. Not market cap and not book value, just the revenue. No, no. Different story. Tesla's revenues goes up a lot faster than Illumina. Yeah, these kind of things make me think that another great tip of Peter Lynch: the best stock to invest in is the stock that you already have. There's so much wisdom in that because, yeah, I mean, as an investor, you're always studying the market. So your current portfolio reflects the best choices you've been able to make. And if you have an opportunity, the best opportunity you see, and if you have an opportunity to invest more because you have some cash available, or what is the best stock to invest in? Probably the ones you're investing already in. There's also a lot of benefit in sticking with the same because it doesn't require much extra work. You know it in and out. For the same reason, it's a better idea to make another child with your current girlfriend or current wife than make a child with another wife, because well, that does bring in a lot of complexities and extra costs and extra management and extra follow-up, and it's not a very um, cost-effective way to create a second child. And the same is true with investing. To look for another great investment, I've been looking. It's not easy. Huh? It's not easy. But yeah, Tesla is just absolutely killing it in growth. It's really unseen. From 1 billion, this is 2011. Wait, 11, 12. This is 2012. From 1 billion to 20 billion in 8 years, 9 years. Yeah. Yeah. So yeah, maybe I should cancel the whole idea to invest in anything else and just stick to Tesla. Huh? That's not a bad idea, maybe. Yeah, I posted recently. There's the holy grail to investing, and how you can build security while also how you can achieve fast growth while also having security is to is to um, is to have different non-correlated investments. Huh? And and then if they all have great risk reward ratios, if one fails, that's not a problem because you have other ones. Even like from a mathematical perspective, there's only one in 10 that needs to succeed, and that, for example, has 100x potential. Well, if one does 100x and all nine others fail, go to zero, you still tenfolded your portfolio. So that's really the key to creating high growth while also having a lot of security. The problem with this strategy is that it is so hard to achieve because I can't find any other great investments. It's like the mind is, or my mind is not able to find it, to look to it just nothing compares to the great investments that I have, and this is probably very very subjective. But maybe it's also like even in crypto world, like yeah, I really believe in Bitcoin Cash and Ethereum as a second, and there are very few other coins that I even have like believe in. Huh? It's like maybe it's like with the ladies again. It's very hard. Like it's possible to love different partners, but human nature tends to really focus on one or a few at most, huh? Because and it seems to be the same with these investments. And if you look at who succeeds in becoming really rich, it's actually entrepreneurs. And why? Because they only have one investment, that's their company, and they remain fully invested. They don't diversify whatsoever. They don't have the philosophy of diversification. Yeah, within the company, they might start several projects and bet on different horses, but all their money is invested in that one share of their company, and they focus fully on building that out. And maybe the same is true for investors, that they really need to actually focus on one or only a few, and that more is just not manageable, even though there are of course many more great opportunities in the world. Just like with the ladies, yeah, you picked one or a few, but there are of course from the billions of ladies many more that are would be great partners for you. But it's just not possible to focus on more, and you do have to make a decision and go for something in order to grow, and dedicate to one or a few. And that's I think what I probably need to do here, huh? Instead of I've been really looking for other investments, and nothing comes even close to the investments I have. So maybe I should cancel it, and that might be the best idea. Thanks for watching, guys. Have a great day.